All right, let's talk about one of the most dangerous and fascinating traps in all of finance, overconfidence. It's this psychological blind spot that costs investors absolute fortunes. And today, we're going to unpack exactly how it works, and more importantly, how you can avoid it. So let me start by asking you a really simple, honest question. And I want you to actually pause and think about this. Do you, personally, believe that you are an above-average investor? That your skill, your knowledge, puts you in the top half? Be honest with yourself. Okay, well, here's the reality. When you survey people, about 80% of us believe we're above average. But the hard data? It's brutal. A staggering 90% of active investors actually underperform the market. You see that massive gap? That's not just a math problem. That is a deep psychological paradox that we are all susceptible to. And this right here leads us to what we can call the investor's paradox. It's this wild idea that feeling like you're winning, feeling successful, can actually be your single biggest risk. So how on earth does this happen? Well, this whole performance illusion, it's really built on three big, powerful psychological traps. So let's dive in and break them down one by one. Okay, so pillar number one is something called the illusion of knowledge. It's this really seductive idea, right? That the more information we consume, the more news, the more reports, the more analysis, the smarter our decisions get. But as you're about to see, the data tells a very different story. So what does that mean? It basically means we tend to believe that more info equals more accuracy. Our confidence just shoots through the roof with every article we read. But our actual ability to predict what's next, yeah, that often stays completely flat. And you know what? Researchers have actually tested this, and it's fascinating. They gave a group of investors more and more and more data about a company. And the result? Oh, their confidence went sky high. But their actual accuracy in picking the stock's direction? It didn't budge, not one bit. All that extra data just created more confident mistakes. And of course, that misplaced confidence, it leads us right into pillar number two, the illusion of control. This is that little voice in your head, that nagging feeling that if we're just doing something, trading, tweaking our portfolio, we must be steering it towards a better outcome. We start confusing activity with actual influence. We think we can control things that are, let's be honest, largely random. And in investing, this looks like one thing, just excessive, really costly trading. The more we click that buy or sell button, the more in control we feel, even if we're just digging ourselves into a deeper hole. And the numbers on this are, honestly, they're just jaw-dropping. The most active traders consistently underperform by a massive 3 to 8% every single year. But get this, who rates their own performance the highest? You guessed it, the very same traders who are trading the most. That right there, that is the illusion of control in action. All right, and our final pillar, this one might be the most sneaky of them all. It's hindsight bias. You absolutely know this one. It's that classic I knew it all along effect, where our brain just rewrites history to make every lucky guess look like a stroke of pure genius. You see, our brain is a master storyteller. After a stock we bought skyrockets, we conveniently remember all the brilliant reasons we bought it. And we totally forget about all those nights we spent worrying if it was a terrible decision. That's how hindsight bias turns pure dumb luck into skill, and that makes us dangerously overconfident for our next big bet. I mean, just think about it. An investor who bought Reliance way back at 800 rupees will swear to you today they just knew it was going to triple. But if you could magically see their journal from back then, what would you find? Nothing but uncertainty and doubt. Our brains literally erase the doubt and only remember the win. Okay, so we've looked at the psychology behind it, we've seen the traps, but what's the bottom line? What does this actually cost you in real terms? Let's talk about the actual money. It all plays out in this really predictable, dangerous loop. Let's call it the self-deception cycle. It starts with a few lucky wins, right? We immediately tell ourselves that was skill, not luck. That new confidence makes us trade more, maybe take bigger positions, and that of course leads to higher costs and worse returns. But then, hindsight bias kicks in. We focus on our winners, forget the losers, our confidence stays high, and the whole cycle just starts all over again. Okay, let's put some hard numbers to this to make it crystal clear. Imagine two investors. They both start with 10 lakh rupees. Over here on the left, we have the passive investor. They just buy a simple index fund and earn the market average, let's say 12%. And over here on the right, we've got our overconfident investor. They're actively trading, and after all those extra fees and costs, they only net about 9% a year. So after a decade, what's the difference? 7 lakh rupees. That is the real, tangible cost of overconfidence. We're talking nearly a quarter of their potential wealth just gone. And not because the market crashed. It's because of their own behavior. That is a truly staggering price to pay just for feeling smart. Okay, so that's the bad news. That's the problem. But here's the good news. You can absolutely fight back against this. And the solution? Well, it's a simple framework built on humility. All right, so here's the framework. It all starts with being honest with yourself. First, acknowledge that randomness and luck play a huge role. Second, track your true performance, and I mean after all the costs are taken out. Next, you build a process. Start a decision journal. Why did you buy that stock? What were you thinking? And then actually conduct regular reviews of your performance. And finally, you just have to embrace simplicity. Your default should be low-cost indexing. Focus only on the things you can actually control, like your costs and your overall strategy. So, how do we take this framework and actually turn it into a sustainable daily discipline? Well, it really starts by asking yourself 3 pretty tough questions. So, before you make your next trade, I want you to stop and ask yourself this. What is my actual annual return after all the fees, all the taxes, all the costs? Not just the return on your one big winner, but for your entire portfolio. Okay, next question. Once you have that number, how does it actually compare to just buying a simple, boring, nifty index fund? Be brutally honest. Have all those hours you spent researching and trading, have they actually added any real value over just buying the market and walking away? And here's the final and probably the toughest question of all. Ask yourself, am I genuinely a skilled investor, or have I just been incredibly lucky riding a bull market that has gone mostly up for years? Answering that one question honestly, that is the first real step towards genuine long-term success. And this brings us to the ultimate paradox of investing. It's wild, but the less confident you are in your ability to beat the market, the better your returns are likely to be. Think about it. Why? Because less certainty leads to less trading. Less trading means lower costs and, therefore, higher net returns. True confidence, it isn't loud and frantic. It's quiet. It's disciplined. It's humble. And that humility, that is the true cornerstone of building wealth.